Australia's latest inflation report has thrown market expectations for further rate cuts into disarray. After a hotter than expected September quarter print, the door to another rate cut in November has effectively been slammed shut, and potentially for this cycle. The data points to lingering price pressures in the domestic economy, leaving the risk that the next move in Australia's cash rate could well be higher, unless labour market conditions weaken meaningfully in the months ahead. The market's focus was on trimmed mean inflation, the RBA's preferred underlying measure. It accelerated to 3% over the year, hitting the top of its 2 to 3% target band for the first time since late 2024. The RBA targets the midpoint of that band at 2.5%, so the result is already above its comfort zone. But when you annualize that out over the past 2 quarters, trim mean inflation is running at a scorching 3.3%, warning of price pressures building beneath the surface. The RBA, well, it had forecast a trim mean quarterly reading of 0.6%. Earlier this week, Governor Bullock warned that a 0.9% measure would be a material miss relative to its expectations. Given the actual outcome was even hotter, the odds of another rate cut quickly collapsed. Market pricing has swung sharply over the past month. The probability of a November rate cut has fallen to just 7%, with December only slightly higher at 17%. In contrast, after the September jobs report, which showed unemployment jumping to 4.5%, which is 0.2 above the RBA's forecast peak through to the end of 2027, markets are pricing in at least one rate cut before Christmas, with the meaningful risk of a second. Well, that's now clearly changed. With inflation running hotter than expected, the RBA will need to see a meaningful deterioration in the labour market before even considering another rate cut. The next move in the cash rate is now firmly data-driven, and unless the jobs market weakens materially, further easing this cycle looks to be off the table.